Have you ever wondered how you could get paid by your investments, like actually get cash in hand, without ever selling a single share? Well, today we're going to dive into exactly that. We're talking about dividend yield, a super powerful metric that can turn your portfolio into an income-generating machine. But, and this is a big but, only if you really understand how to use it right.
I mean, it's a fantastic question, right? How can your stocks actually pay you a regular income? Kind of like a paycheck, even if you never, ever sell them. That, right there, is the core promise of dividend investing. And the dividend yield, well, that's the key that unlocks the whole thing.
All right, so here's our roadmap for today. We'll kick things off with that big promise of passive income. Then we'll decode the formula behind it. It's pretty simple, I promise. Then we get to the really juicy part, the allure of a high yield and the hidden trap that so often comes with it. From there, we'll figure out how to tell if a dividend is actually safe and then pull it all together into a much smarter strategy.
So, what exactly is this passive income promise? Well, at its core, a dividend is just a company sharing its success directly with you, the shareholder. You can think of it as your reward for owning a piece of a profitable business. It's really the bedrock of income investing.
The dividend yield basically just puts a number on that reward. It tells you straight up how much cash you're getting back each year for every single dollar you put in. So for example, if a stock costs, say, $100 and it pays out a $3 dividend every year, its yield is 3%. It's that simple. And that little percentage is a really powerful way to compare the income potential of different stocks.
Okay, now let's pop the hood and look at the simple math that drives this metric. It's not complicated at all, but really understanding its moving parts is absolutely crucial.
The formula itself is super simple. Just take the annual dividend per share and divide it by the current stock price. Now here's the part you absolutely have to remember. This is critical. The yield moves inversely with the stock price. Just think about that for a second. If the dividend payout stays the same, but the stock's price gets cheaper, well, your percentage return on that investment goes up. That one single idea is the key to everything we're about to talk about. Now, there's a really important distinction you got to know about. Are we looking backward or forward? See, the trailing yield is based on what the company has already paid out. It's history, it's a fact. But the forward yield, that's just an estimate of what they might pay in the future. And listen, if you ever see a big gap between those two, where the forward yield is way lower than the trailing one, that is a massive red flag. It's basically the market whispering in your ear, hey, a dividend cut might be on the way. And that brings us right to the central conflict for any income investor. That seductive, but often very, very dangerous allure of a super high yield. You see a chart like this, and the choice just seems obvious, doesn't it? You've got an 8% yield from some stock XYZ versus the market average, which is hanging out around 1.3%. You'd think, well, more income's always better.
But is it really that simple? Is a higher yield always the better choice? In the world of investing, the easy answer is very rarely the right one. And in this case, the answer is often a resounding no.
This is what's known as the dividend value trap, and it is one of the most common and costly mistakes an income investor can make. You see that high yield and you think you're getting a bargain, but you might actually be stepping onto a sinking ship. So how does this trap actually work? Let's break it down step by step. First, the business itself starts to have problems. Then, as investors get nervous and start selling, the stock price just drops like a rock. Now remember our formula. With the price on the bottom of that fraction, a falling price makes the yield artificially spike up. It suddenly looks incredibly attractive, right? That's the bait. And unsuspecting investors pile in. Right before the company has to announce the bad news, they're cutting the dividend, and boom, the stock price falls off a cliff.
So, the million-dollar question is, how do you avoid this trap? Well, the answer lies in doing a quick financial health checkup, using the same key metrics that the pros rely on to see if that high yield is for real. Our first tool is the dividend payout ratio. It answers a really simple question. What percentage of the company's profits is it sending out to shareholders? This tells you how much of a safety cushion the company has if earnings take a little dip. And here's a pretty simple way to think about that ratio. Anything under 70% is generally seen as healthy. There's a good safety cushion there. But once you start creeping above 75%, you should probably start paying closer attention. And if it's over 100%, whoa, that's a 5-alarm fire. It literally means the company is paying out more money in dividends than it's making in profit. That's the very definition of unsustainable. But here's the thing. Earnings can sometimes be misleading because of accounting rules. That's why the real gold standard for checking dividend safety is free cash flow. This is the actual hard cash the business has left over, and it's much harder to fudge the numbers because it tracks the real money moving in and out of the company's bank account.
And this right here is the ultimate test for any dividend. Is that total dividend payment comfortably covered by the company's free cash flow? Because if it's not, that could mean the company is borrowing money or selling off assets just to send you that check. And you have to understand, that's not a return on your investment, that's a return of your investment. It's them giving you your own money back, and that is a crystal clear sign that you're in a trap.
Okay, so we've seen the problem and we have the tools to analyze it. Now let's put it all together into a smarter strategy that helps you move from a novice to more of an expert mindset.
This is where shifting to an expert mindset really pays off. You start to see that a high yield is completely relative, right? A 3% yield from a super stable utility company? That's just business as usual. They're basically cash cows. But what about a 1% yield from a fast-growing tech company that needs to reinvest every dollar it can find? In that case, paying any dividend at all could be a huge statement of financial strength. Context, you see, is absolutely everything.
So let's wrap this all up into a disciplined framework you can actually use. First, use a high yield as a signal to start your research, not end it. Second, always benchmark that yield against its sector. Is it normal or is it an outlier? Third, and this is a big one, prioritize a history of dividend growth over just a high static yield. A company that consistently raises its dividend is showing massive confidence. And finally, you have to validate the whole thing with the payout ratio and, most importantly, rock-solid free cash flow coverage. And of course, diversify.
And that really brings us to the final thought here. Look, just chasing the highest number you see on a screen is a recipe for disaster. It rarely works out. The real goal for any truly successful income investor isn't about the highest yield. It's about finding reliable, sustainable, and hopefully growing income. Income that you can actually count on year after year.